Inside 80 million American homes, television screens are integrated into a data network owned by a grocery store. Every minute of viewing time is logged and categorized, creating a behavioral map that leads directly back to Bentonville, Arkansas. In February 2026, Walmart's market capitalization crossed the $1 trillion threshold. This valuation places the company ahead of the entire GDP of Saudi Arabia and makes it more valuable than JP Chase, Visa, and ExxonMobil. This chart compares Walmart's physical retail operating margin, a thin 4%, against the higher margins of major tech firms. Despite the low profitability of selling groceries, Wall Street is rewarding Walmart with a 46 times earnings multiple. For a traditional grocery retailer, a 46 multiple is an outlier. Typically, these businesses trade at 15 to 20 times their earnings, suggesting the market no longer views Walmart as a simple seller of consumer goods. This valuation reflects a transition from physical retail toward a mathematical formula of extraction. It is a strategy decades in the making, built on a foundation of structural leverage. The empire was built on a policy known as +1. Every year, Walmart demanded a mandatory 1% price cut from its suppliers. Compounded over time, this 1% mandate made domestic manufacturing mathematically impossible. Suppliers were forced to relocate production to offshore facilities in Bangladesh and Vietnam to meet Walmart's pricing requirements. Locally, Walmart employed predatory pricing, selling goods below cost until independent town businesses could no longer compete. Once the local competition vanished, the community's economic heartbeat was replaced by a single store staffed with part-time labor. To manage labor costs, the company implemented a strict 29-hour weekly cap for 1.6 million associates. This specific threshold allowed the company to legally avoid providing health insurance benefits. This labor structure shifts the cost of worker health care to the public. Through Medicaid and food assistance programs, American taxpayers provide the Walton family with an estimated $6 billion annual subsidy. These poverty wages and hollowed-out towns served as the taxpayer-funded foundations of Walmart's business model, providing the capital necessary for their global scale. In 1936, the United States passed the Robinson-Patman Act. The law was designed to prevent massive buyers from using their size to extract special pricing that smaller competitors could never match. Federal enforcement of this anti-monopoly protection effectively ceased in 1981. This regulatory shift allowed Walmart to use its massive buying power to dictate terms to the entire consumer goods industry. This created a monopsony, one buyer controlling the market. To reach 270 million customers, manufacturers accepted Walmart's terms. Today, this control is digitized through Walmart Connect. Suppliers now pay subscription fees to buy back their own sales data just to maintain shelf visibility. Walmart has moved beyond selling products. They now charge manufacturers digital rent to reach the consumer, turning their store into a high-margin advertising toll booth. This drive for extreme cost efficiency resulted in industrial tragedies like the Rana Plaza collapse. Layers of subcontracting maintained a supply chain where over 1,000 workers died in a facility they were too poor to leave. Domestic labor has faced similar extraction. In 2026, the Federal Trade Commission targeted Walmart for deceptive earnings claims used to recruit independent Spark delivery drivers. These drivers are classified as independent contractors, exempting Walmart from providing benefits or minimum wage guarantees. However, the company also required these drivers to receive their payments through specific fintech apps. Routing pay through these proprietary accounts allowed the company to siphon transaction and withdrawal fees from the very workers making their deliveries. By denying workers employee status while simultaneously acting as their bank, Walmart created a closed loop of financial extraction at every level of the workforce. In 2024, Walmart acquired Vizio for $2.5 billion. The acquisition focused on the data generated by the televisions rather than the hardware itself. Vizio's operating system tracks everything you watch and links that data directly to your physical Walmart purchases. This closed attribution loop allows the company to prove to advertisers exactly how many television ads led to an in-store transaction. This surveillance is being scaled through Google Gemini and Sparky, an AI shopping agent designed to automate the consumer experience. Sparky uses search history, viewing patterns, and past receipts to predict and influence future purchases. This behavioral modeling is designed to maximize the size of every customer's cart before they even realize they need an item. Everyday low prices have transitioned into a customer acquisition cost for a surveillance machine. The company's primary value now lies in the behavioral fingerprint of the shoppers themselves. This trillion-dollar data empire rests on a fragile technological foundation, struggling to secure the hundreds of millions of personal records it collects. A string of cybersecurity failures, including a massive breach by the group Shiny Hunters, has already exposed sensitive transaction and customer data to the dark web. Wall Street's current valuation depends on an unbroken chain of consumer trust. If the intimate details of 80 million households are compromised, the data flywheel that drives their stock price could reverse. At the same time, regulators are moving to revive 1930s-era antitrust laws to challenge the company's control over pricing and data. Walmart is unlikely to fail in the near term, but its future is now tied to a high-stakes gamble. The company must decide if its extraction model can survive a systemic data collapse or the sudden return of the laws it spent decades outrunning.